It's Andy Kim again, and then welcome back to International Finance Lecture, the week 5 portion of my lecture. Today we're going to talk about the basics of foreign exchange market and in the convention in the market, right? But before that, let's go through some interesting current issues, right? What happened over the last week or couple of weeks, okay? The March of 2020, okay? Very dynamic and turbulent period in capital market as well as real economy, right? And yesterday you saw that U.S. Department of Labor, they've announced that the newly registered kind of unemployed people, the number of unemployment was more than 3 million, okay, more than 3 million. Very, very surprising number, but the U.S. market is very dynamic, okay, and it changes very flexibly. So let's see what's going to happen, okay. Let's keep our fingers crossed. Anyway, so what I'm going to show you over here is the yield curve. Remember what the yield curve was about? It was about the yield to maturity of treasury securities, especially here, this is about the US market, right? And then what you see on the vertical axis is the percentage point of the yield to maturity for each given securities, right? Securities. And what you see on the horizontal axis is the securities maturity. So it starts from 1 month maturity and it goes on all the way down to 30 years maturity. Now, typically, what would you expect the yield curve to be? Well, the slope of the yield curve will be like this usually, which means shorter term maturity yield has to be lower than the longer term maturity yield. Make sense? Why? Because there should be some time premium over here. I have to wait 24 years and 11 more months, right? Compared to that guy. So I want to charge more. I mean, I want to expect more return for my waiting, okay? But interesting thing is the yield curve was inverted at the early March period, okay? Very strange, inverted yield curve. Why is that the case? Well, typically, people say this is because investors in the capital market are expecting huge uncertainty in the shorter horizon than the longer horizon. In like one year from now, well, things are going to get back to normal. But in 1 month's time horizon or 2 months time horizon, too much uncertainty coming up, kind of tsunami coming up, wah! Kind of things, right? But in the longer horizon, that's going to be okay. So in that case, the yield curve flips like this, gets inverted like this, okay? Now, that's the beginning of March, right? And why was it inverted? What was the uncertainty? Of course, Corona-19 virus, you can see that, right? Now we are at the end of March, right? By now we understand and realize this uncertainty. Well, we are going through this uncertainty right now. Anyway, the next slide is about the yield curve in the next day, and I'm going to show you day by day yield curve, and then it show you like a motion picture. Shall I go that for now and then come back to this slide later? Okay. So I'm doing one, okay, the next day, the next day, the next day, the next day, and 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 the next day, going on, and the Fed announces something, and then keeps on happening something over there, and then moves on, moves on, moves on, moves on, like this, okay? Now, so that's the thing I wanted to show you a little bit. Now, interestingly, right, here's what's happening. Usually in treasury market, right, 국고채 market, the investors will be a little bit surprised if the yield to maturity changes by about more than like 1 basis point or 2 basis points, and they will be like, what happened? The 1 basis point means like 0.01 percentage point, right? Very stable market. But as you see, day by day, the movement of the yield to maturity is not just 0.01%, okay? It's more than 0.1%, which is 10 times the magnitude or much more, okay? Happening within one day, as if it is like crash and then boom, like too much of a rally and too much of a bust is going on in a short while, okay? Jesus Christ, is there any kind of a sidecar or kind of a circuit breaker in the treasury market? In the stock market, at least they have it, but in the bond market, they don't, right? And what was going on? Okay, basically that's going to be your homework question, right? I'm going to throw you some social media message that I got from my friends who used to work as a hedge fund manager in the New York City, and then you're going to interpret those things and then figure out and tell me what was happening over there, what was causing this dramatic movement. Right, so if you go by day, right, March 4th, the bond market, okay, will get surprised if the yield to maturity changes more than 1 basis points, right, one tick by tick, right? They will be like, what's happening in the market? But during this period, okay, the yield to maturities for each securities, right, was changing much more than 10 basis points or something, right? And you see that there was a dramatic bond price increase up until March 5th. What could be the reason about there? Well, bond price was increasing dramatically, which means people were running for secure or safer asset. Right, safer assets. The safest assets these days are, U.S. Treasury by far, right? People don't even run for gold, right? Why is that the case? Because the U.S. Treasury, U.S. dollar itself, is a key currency or 기축 통화 in Korean terminology, right? So that's what was happening in the beginning of March. Let's see, okay? It keeps going down, the yield to maturity, which means keeps going up for U.S. bond price. And then, basically, the things were happening this way, but in March 10th, right? Very strange movements start to happen, okay? If you look at the longer term maturity bonds, right? The yield to maturity start to increase, okay? Bump up by more than what? 10 basis points or almost like 20 basis points in a day. What was happening there, right? Gotta tell me later on, okay? Essentially it was a bond market crash on that day. And then things keep on happening in the longer term maturity. The bond yield shoots up like crazy, right? Something strange is happening. And then there comes U.S. Treasury chairman, okay? They announced that the Fed funds rate will be cut down. The target rates will be cut down to 0%, okay? To stimulate the economy, and this is a monetary policy. I told you, I spent enough of time about it. And then the next day, what happens? March 16th, right? Compared to March 13th, the Treasury yield in general got lowered down slightly. You see that, right? From here to there. And then the following day, what happens? Well, for shorter term end, right? Short term end, you see the bond yield keeps on going down, as has been, promised by the Fed. Okay, quite expected. But for longer term maturity, the strange thing that I said before keeps on happening. Okay, over here. What the heck? And you see the next day and the next day, okay, and the next day, things keep on happening. But the thing is, shorter term maturity essentially got down to 0% interest rate. Longer term maturity, well, the crash seemed to be soothed a lot. Okay, situation got a lot better. Okay, and then again, the longer term maturity bond yield slightly increases, but is generally kept over there. Anyway, so that's the final yield curve that I can show you. What you can see in general is that in a short-term maturity U.S. Treasury, right? They go together with the Fed's announcement, the target Fed funds rate. Okay, as I said before, the monetary policy of the Fed, okay, through FOM, what's that? Open market operations, right? That is closely related to short-term maturity treasuries, right? They just play with the short-term securities. They don't usually play with longer-term securities. But what was different this time is that they announced $700 billion or what, dollars of quantitative easing package, right? So that was promised amount to be spent on this longer-term maturity securities as well, so that the impact was ubiquitous throughout the maturity. Okay, but that's not the point of my homework. Okay, but that's not the point of my homework. My point of homework is what the heck is going on with this bond market crash. Okay, that was not typically reported in the news. Okay, I want you to think about those. Okay, bond market crash. I show you with this diagram over here. Now, that's that. Then, flight for safety in global market happened. Just to rehash what was going on in the diagrams, right? Global economic crisis happens, and what typically happened for investors in international investors investing in South Korea, well, they sell Korean assets to invest in U.S. Treasury. Okay, not just foreign investors, but domestic investors as well. Okay, Samsung 자산운용 or kind of 자산운용 or that kind of Korean Investment Corporation, KIC guys, right? They all do the same thing, right? We are living in a global world, and they are global players as well. And then sell Korea and then buy U.S. Treasury. So U.S. Treasury rally, you witnessed that, right? The price of the bond increase, the yield of the bond decrease like crazy. The demand for US dollar increases, right? Of course, you have to convert your currency first. And then the supply of Korean won increases, which means the US dollar price, okay, denominated in Korean won, goes up like crazy, okay? US dollar value was going up like crazy to hit 1,300 Korean won per US dollar at one point of this observation period. US Treasury price goes up, yield goes down. That's what we found out. Impact on Korean won to US dollar rate, FX rate, as you see over here, right, in this chart, at one point in our observation period, okay, the US dollar price was shooting up like crazy, 1,300 won per dollars. And then the next day, let's see, and then the next day, what happens? Well, the news announced, okay, got news announced like this. Oh, US Central Bank and then Korea Central Bank, they are now going through currency swap, okay, 통화 swap transaction, okay, is going on. So don't worry, there will be enough of a supply for US dollar to cancel those higher demand, okay, and then the Korean currency value will be stabilized back again. And then some of the newspapers were saying that Thank God we have great leaders, right? Israel power, their hotline calling, have, saved our lives, right? Like this, right? Thank God. But anyway, after the announcement, right, of this swap, okay, contract between the U.S. Central Bank and Korean Central Bank, what happened? Well, of course, it stabilized the FX market in Korea, right? As you see, the currency exchange rate is now 1219.37. Okay, so if you had invested in US dollars at the peak, right, 1300 Korean won, you must have screwed yourself by now. Okay, I hope you did not, right? Anyway, so that was having some significant stabilizing effect. But wait a minute, okay, wait a minute. Getting back to that announcement, right, which was announced on March 19th, right, was Korea the only country that the U.S. Central Bank said, let's do currency swap, okay, so that we stabilize your currency, kind of things. Or your currency stabilize my currency the other way around, okay, that could be possible. Anyway, but you make sure, visit the press release website of Federal Reserve Board. Okay, here we see the press release on that day. It says what? Federal Reserve announces the establishment of temporary US dollar liquidity arrangements with other central banks. What the heck is that? Well, let's go. Okay, FR on Thursday announced the establishment of temporary US dollar liquidity arrangement, or which means swap lines, right? Swap lines. Sounds familiar? Currency swap? Yeah. With the Reserve Bank of Australia, okay, and Banco Central de Brazil, okay, and Denmark National Bank, and then Bank of Korea, okay, holy cow, so we are one of them, okay, not the only one, right? The Banco de Mexico, the Norges Bank, and the Reserve Bank of New Zealand, but yes, New Zealand, and Monetary Authority of Singapore, and Sveriges Riksbank, that's Swedish bank, right? These facilities, like those already established between the Federal Reserve and other central banks, are designed to help lessen the strains in global US dollar funding markets, thereby mitigating the effect of these strains on the supply of the credit to household and business, both domestically and abroad. Wait a minute. So the currency swap that Korea had in the United States, okay, Korea was not the only one, and it was not necessarily U.S. rescuing Korea, but they had their own purpose of it. Okay, so why is that the case? I showed you this picture before, right? This is the dollars. How do you say the year-to-date change in the strength of each country's currency against the dollar. So you see Euro, Thailand baht, and South Korean won, and Canadian dollars, UK pound, and Australian dollars, and Russian ruble, Mexican peso. Their value relative to US dollar has been plunging like crazy. Okay, so what does this imply to the US dollar and the US market? Of course, there's inverse relation. You could see the dollar's strength is skyrocketing. Okay, so we get back to our original slide like this with a slight change over here. Supply of Korean won increases because everybody wants to get US dollar, but Korean won is not the only currency in the world, right? Mexican peso, and then Russian rubles, and then Australian dollars, and then what else, right? Swedish krona, all of them, right, are experiencing the same thing, okay? The safest asset is not Swedish krona or Swiss franc or whatever. Dump it and then go for US dollar. They all experience the same thing. We Koreans have this kind of bias because in 1997 we suffered East Asian currency crisis, so much so that we have this kind of false picture in our mind. Oh, those foreigners are only attacking us, and we are the only victims in the whole world. And the Korean asset is the weakest of all assets, and they're going to dump it. But wait a minute. We are one of those major guys as well these days. So everybody is dumping everybody's assets, and they are running for US dollar. That is a problem right now. That is a problem. Strong dollar, okay, because it's a key currency or 기축통화. I don't know how to pronounce it in Chinese. 기축통화, maybe, I don't know. And then weakening price competitiveness of U.S. products and the services is a problem, okay, for U.S. perspective. You see that J-curve, we talked about it before, right? J-curve, what was that about? If your currency, okay, is depreciated in the short run, you're going to suffer budget, the current account deficit, trade deficit, because in the short run, imported materials are there, right? Imported materials, its import price will go up, okay, so that you will suffer trade deficit in the short run. But in the long run, what happens? Your depreciated currency, okay, gives strength to the product in the price competitiveness, right? Your product gets cheaper in the export market, so that in the long run you will have trade surpluses, right? That was the J-curve's beauty over there. So inverted J-curve, you can think about it if you think about the US perspective, right? Too strong dollars, okay, which means the US products will suffer from loss of competence in their product market price. It's too expensive. They cannot sell it in the long run, okay? So the trade balance will be what? Deficit in the long run for them. They don't want to create this kind of things. They're already in big trouble, okay? That's why, I mean, hey, the trade imbalance was the first and foremost thing this Trump administration has been trying to resolve somehow. And this strong dollar does not help them. So in that sense, what should they do? They should supply more US dollar to all around the world. Korea, Bank of Korea, here is your US dollar. Take it, please, okay? I will supply you. And then Banco de Mexico, here you are. Go ahead and, use it, US dollar, okay? Swap it with your Mexican peso, and then Korean won, and Swedish krona, and then Swiss franc, all these things, right? So that was what was happening. All rational calculation going on, right? So let's not get misled. And then here is another press release 4 days before, March 15th, okay? What was that? Coordinated central bank action to enhance the provision of US dollar liquidity. What? Here you see the Bank of Canada, Banque du Canada, and Bank of England, Bank of Japan, konnichiwa, and the European Central Bank, and then the Federal Reserve and the Swiss National Bank are today announcing a coordinated action to enhance the provision of liquidity via the standing US dollar liquidity swap line arrangements. Wow. So they already, okay, it was kind of a prelude, okay, to Korea's market as well, right? 4 days before, okay, those sophisticated investors in the market must have known this. Currency swap among the central banks of these major countries, 5 different countries are happening or taking place, right? So in a bigger magnitude first, and then 4 days later, cascading down to Korea and then Mexico and the Swedish and then all these banks, right? They did the swap transaction, right? So all in all, it gets back to the idea that I said before, okay? Nothing is done out of goodwill. Everything is based on rational calculation in the global financial market. right? U.S. market, U.S. Treasury, and U.S. Central Bank, they also want their dollars, weakening dollars, please, not strengthening dollars, right? So go ahead and read all these kind of press releases in the following webpage that I suggest you, okay? And then, so today's portion is about Chapter 5, Market for Foreign Exchange, right? The market for foreign exchange. So it's going to be about the basic convention in this FX market, right? So let's go. FX rate today, you can check out all the time, right? Click it and you will see this. And another thing, okay. US dollar is 1219.28 Korean won these days, right? You can play with this with other currencies as well, okay? As I said before, the US dollars the value has been strengthening these days until we had those currency swap among these central banks, right? The purpose of U.S. central bank is, again, number one, they have to stabilize their price level, right? Number two, they have to maximize their employment in the U.S. market. So unemployment rate going up is no good news for them. So they have to lower it down. By how? Well, they have to guarantee or make the U.S. products, it has to be competitive, has to be cheaper. For that purpose, U.S. dollar has to be weaker. Okay, so that's why we had this kind of currency swap in central bank level. Chapter outline, we're going to see like this. Talk about functions and structure of the FX market. Who are those market participants? And then what is those correspondent banking kind of things, right? What is that? And then we're going to talk about spot market, and then spot market, and then forward market. We're going to talk about it. And then for spot market, well, how do we quote, right? The FX the foreign exchange rate, okay? What is the bid and what is ask price, and what is the bid-ask spread? And what is the spot market versus forward market, and then between two currencies, and how about 3 different currencies? There should be some cross exchange rate quotations, and then based on that, 3 different currencies, you can think about triangular arbitrage, something called, right? So we're going to talk about the kind of concepts and do some calculations. So get ready with this calculator, right? You need some calculator. And then spot exchange rate market microstructure. We're going to discuss a little bit about it, but it's basically about the bid-ask spread. Microstructure, what is that? The structure of the market, a little bit, okay? Buy and sell, bid and ask, that kind of things, right? And then forward market, well, how do we quote the rates, okay? And then long and short forward position, what do we mean by that? And then non-deliverable forward contracts, or 여배 선물환 kind of things in Korean terminology, right? What is that? Okay, you're going to talk about that. And then forward cross exchange rates, again, for 3 different currencies, right? We can think about cross exchange rates, okay? Why is that the case, by the way? Because there is one single currency that you always can, compute and then transact very frequently. Like 80% of the transactions in FX market is done in US currency, US dollars. So everything is priced with respect to US dollars, and then everything else is, right? They should be calculated based on their exchange rate with the US dollars and your currencies with respect to exchange US dollars, and then you and me cross exchange rates. You can compute it, right? That's basically how it works. And then swap transactions, we're going to talk a little bit about it, and then forward premium, that kind of concept will be discussed. And then exchange traded currency fund is also there, ETF in the stock market. Wow, a fund in the stock market traces the foreign exchange. So do I have to invest in US dollars by converting my money, Korean won, into US dollars and then put over there? Well, you don't. Okay, what you need to do is just buy US dollar ETF in Korean stock market. Then you're okay with that, right? And then, so lastly, we're going to finish by summaries. Now, here I show you my diagram of foreign exchange market. Okay, people say foreign exchange market is two-tiered market. Okay, so what I drew in my whiteboard is like this, where two-tiered, two levels of players, I would say, two groups of players maybe. So first group or first tier of the market should be something called wholesale market or interbank market. Interbank, which means bank to bank, right? Bank to bank market. So in this picture, Citibank versus Deutsche Bank, right? Citibank in the United States and Deutsche Bank in the Europe, right? Big institutions, right? They transact each other, okay? The currencies, right? FX market. This is wholesale, 도매금융시장, like in Korean terminology. Interbank market. And the other tier is something called retail market or client market. Okay, retail or client market. So in the US, okay, Citibank is there, but they also buy and sell foreign currencies and the domestic currencies with retail clients, or for example, you and me, or not, I'm in Korea, but by the way, but US citizens over there, right? Individuals. Also, there must be some corporations like Apple, okay, Apple. By the way, I realized that this one had to be this way around instead of that, okay? Apple, did you notice that? I never. Anyway, so Apple kind of multinational corporations, they sometimes, I mean, frequently, you know, of course, in real-time basis, they do business all around the world, all different currencies, Korean won, Japanese yen, and then all this kind of. So they have to convert it into US dollars from time to time, and Citibanks look after them. And other US multinational corporations, right? Tesla, and then all these kind of guys must be there. And if you look at European continent, I should split it over here. European continent, Deutsche Bank has to deal with retail clients over there, right? German people, French people, or whatever, Europeans. Also Benz and BMW, right? All these kind of multinational corporations, they earn money in their local currency, and then they may have to convert it into euros, maybe, you know, in that kind of sense, right? They have to, you know, buy and sell together with these guys. So two-tier market, interbank market and client market, you can see it. Right, for interbank market, right, wholesale market, about 100 to 200 banks around the world stand ready to make a market in foreign exchange. Non-bank dealers account for about 40% of the market. This is basically institution-based ones, right? 애들은 가라 kind of, you know, this is not for small players. This is for big fish, big boys, right? Big boys, big girls, whatever. Okay. And then there are FX brothers. Did I say brothers? There are FX brokers, right? Brokers who match buy and sell orders but do not carry inventory and FX specialist. Okay, so in FX market, wholesale market, right? Traders and dealers are two different kinds. So dealers, they carry inventory. They carry their own book, right, of these currencies. They carry those risk, FX risk. Dealers, they have inventory, stuff in their shelf, right? Of course, any dealers, right? It could be on any dealers with any merchandise products, right? It could be any currencies like this. All those dealers, they, by definition, they have inventories in their warehouse, right? In this FX market, their warehouse is full of money. Wow, money and gold and kind of things, right? You may be excited, but it depends. What if the values of what you have in your inventory sucks and tanks, right? You don't want that happening, right? So that's dealers. They take the risk, okay? Brokers, they don't carry those risks, okay? Right? Every now and then those pop-up happens in my window, which, kind of draws attention. But anyway, so brokers, they don't carry those inventory, okay? So that's the distinction. Brokers, middlemen, okay, brokers are the middlemen. 거간꾼, you dealer, come and talk to each other. They, connect these guys, right? Client markets, for the retail market, that's something we always experience as we, in the airport, right? When you go for traveling, okay, of course, nowadays, so many countries locked down, right? Yesterday, China said that they're going to lock down the whole country. Don't come in, no foreigners, please. And then US is also doing that, right? To a certain degree. But before that, right? We used to travel all around, okay? Quite freely. And in that, airports, okay, you should have changed your currency, okay? You see a lot of small banks working over there, retail banks, okay? That's retail FX market. And I also remember at one point, one time I made a stupid mistake in Norway, okay? I forgot to, convert my money, forgetting to bring my cash, right, over there, and then arrived there in the morning, 7 a.m. in the morning. Oh my God, I had such a hard time finding the currency exchange place, right? But basically, I carried my credit card, so nothing, no trouble was there. But I was kind of embarrassed, right? And felt really, really uneasy because lack of liquidity makes you embarrassed, right? So that's that. Market participants include international banks and their customers, and non-bank dealers and FX brokers and central banks, right? So that's that. Interbank market, here are some pictures that are typical about FX dealers, right? FX dealers in the interbank market. Yeah, some of you aspire, okay, to work as an FX dealer and make money. Good luck, right? And then are some pictures about retail FX market. Shinhan Bank over here. And then if you look below, what's that? UOB, that's Singaporean bank, right? This is a picture in Singapore Changi Airport. And then what you see on the right-hand side on that picture, in that picture is RHB, that's Malaysian bank or something, right? Interesting thing is their location of the store or the branch is back to back with each other. So it's kind of competing quite intensively over there. And then UOB is, by the way, third largest bank in Singapore. And Nayong Hwanjeonso, what is that? That's kind of a small exchange place in Busan area. The next, is this. Shares of reported global foreign exchange turnover by country, right? Well, UK turns out to be the biggest FX market, and then the US is 19%, and then Singapore 8%, and Hong Kong 7%, and Japan 6%. And immediately you see that Singapore is bigger FX market than in Japan. Interesting. And then Hong Kong is a slightly smaller, right? Compared to Singapore. And that's that. One interesting thing is in Hong Kong, in capital market wise, right? They are more how do you say, those more aggressive kind of businesses prosper in Hong Kong, whereas in Singapore, less aggressive kind of business prosper over there. I don't know, maybe the regulatory environment, and then the atmosphere of the people in two different countries are very different, I guess. Highly regulated in Singapore versus whatever you want to do is Hong Kong, right? IPO, M&A, those kinds of aggressive transactions, and then those businesses are well done in Hong Kong. But Singapore is bigger in terms of FX or fixed income, okay? And then this kind of rather stable business, okay? And then average electric FX conversations per hour, the graph is shown over here. How active, okay, are the traders over the 24 hours, right? One key message is that FX market, it never sleeps. 24 hours, 7 days a week, right? Why? Because intuitively you can see that 24 hours, the earth goes around and round and round, right? And then at any given point of time, some part of the world is experiencing daytime. And then they are more active during this daytime, and then buying and selling, all those things, right? You see in the 3 a.m. or 4 a.m., okay, time, that's Tokyo lunchtime, right, over here, right? Asia market is open. Korea, Tokyo, Japan, they are open. But during this lunchtime, we have to eat something, sushi or udon, or in Korea, bibimbap, right? No time to trade. So less of a transaction or conversation is going on among these FX dealers. Less active during that hour. But afterwards, in the afternoon hours, it's more active. And then Europe market opens by the end of the day of Asian market, right? And then London market opens, right? And then, as I said before, London is the biggest FX market in the previous chart. So that's why you see a lot more activities going on, conversation activities going on, and then during this time. And by that time, Asia market closes and they go to bed. And then American market opens later on, and that's the time when the London market peaks off, right? Goes down, and then New York market start to take off, right? And then afterwards, the market settles down peacefully, I guess, right? 6 p.m. in New York, and then afterwards Tokyo opens, right? There is some intermittent, right, silent hours, but that's that. Next, let's see. Right, correspondent banking. Okay, there is some word called terminology called correspondent banking. What is that about, right? Correspondent in Korean terminology. Well, it's kind of 특파원 기자 kind of things, right? Or 원거리 거래처 in Korean interpretation. So you have some, large commercial banks maintain demand deposit accounts with one another, which facilitates the efficient functioning of the FX market. So big banks, right? Big banks, Bank of America and then Deutsche Bank, let's say, okay? Each time they do FX transaction, let's say Bank of America wants to buy euro from Deutsche Bank, and then Deutsche Bank wants to buy US dollar from Bank of America, okay, giving their euro currency. Well, crude way of doing it in primitive age, right? Each transaction may take place differently, right? I want to exchange my dollars to you and then give me euro and things like that, transaction by transaction. But later on, you realize that, what the heck, man? As long as Bank of America, you keep a deposit account in Deutsche Bank, and then in that deposit account, by the way, has two different kinds, let's say. One in US dollar deposit account, the other euro deposit account. And then me, Deutsche Bank, have deposit account in your bank, Bank of America, okay? US dollar account, and then euro account, euro account, right? We can switch it somehow, right? Instead of doing separate transactions or each time, okay? So correspondent banking would be less costly in that sense and fastly done. So here's an example. Bank A is in London. Bank B is in New York. The current exchange rate is 1.25 US dollars per British pound. A currency trader employed at Bank A buys $160 million from a currency trader at Bank B for $200 million, settled using its correspondent banking relations. So Bank A, okay, gives 200 million US dollars to Bank B in exchange for 160 million British pounds. So how is it recorded in respective banks' balance sheet is an interesting question here, because both of them have deposit account of with each other, right? And those deposit accounts of the correspondent bank, they have two different separate accounts. So US dollar account and British pound account, okay? British pound account. Now, for Bank A, their balance sheet is shown over here. Now, for them, the asset side, right? The old numbers are just thrown out as an example. And new numbers show the impact of this transaction between those two correspondent banks. So cash in the vault or other assets, they are just given. They're not going to change, of course. But the total asset amount, okay, is an interesting one. They will not change either, okay? Why is that the case? Didn't Bank A give $200 million to Bank B so that the asset has to decrease? No. This is because, it's not going to change because in return, they got British pounds, 160, okay? So if you look at the asset side of Bank A, pound deposit at Bank B goes up by 160 because Bank B gave them 160 million British pounds, okay? What did Bank A give in return? Well, $200 million US dollars. So deposit at Bank B, okay, in US dollar account, that balance goes down by 200. So that's what's happening over here, right? Excuse me. And if you look at the liability side, okay, and equity, right? Of course, equities will not change. Nothing changed, okay? Other liabilities, forget about it. They're going to be the same, okay? But the thing is, their liability, Bank A's liabilities, significant part of the liabilities is deposit accounts of various parties, right? And Bank B has deposit account in Bank A, okay? So correspondent banking relation tells that with this transaction, okay, Bank B's pound deposit, okay, will go down because Bank B gave it to Bank A. Okay, you see, let me change the color over here. Wait, British pound amount of Bank B decreased by 160, and that decrease was offset over here by increase in British pound in asset side. Increase over there, but it's just a offset is kind of misleading over here because those offsetting really happens over here in their US. I should change this color over here in the US dollar account over here. Okay, US dollar account that increased by 200 million. Okay. I hope it is not Corona-19, but anyway. So that's what's happening in this correspondent banking relation. One bank, right? Bank A. What happens to Bank B? Well, similar things, but the opposite direction. Okay. Erase this and then move on to the next slide. How do I do that? Yes. Right. Right. So the same transaction, but for Bank B's perspective, who is in New York City, United States, okay? One thing to notice in Bank A before is that they're a London-based bank, so their balance sheet is stated in British pounds. In contrast, in Bank B, it's US-based one, so their currency unit is in US dollars. Of course, you see British pounds showing up in the balance sheet, but we are assuming the exchange rate of, what was that, 1.2 or something? Yeah, prevailing exchange rate. That explains everything else. Now, the old numbers are given, okay, just take it as it is. The new numbers are the resulting number after this correspondent banking transactions. So Bank B, their asset, okay, they got 200 million US dollars, so they are depositing it at Bank A's account, okay. So the asset, okay, deposited at Bank A increases by 200 million US dollars. And then pound, right? British pound in exchange, you gave it to Bank A. So in what form? Well, knock it off from the deposit account at Bank A. 160 million pounds decrease happened in that sense over here, right? This one, like this, right? That one, like that. Okay? And then liabilities and equities. Again, equities and other liabilities, don't touch it. Doesn't change, right? The only things, or two things change is Bank A's deposit accounts in Bank B, right? From the perspective of Bank B, those deposit is a liability, okay? So Bank A's pound deposit goes up by 160. We are just switching the account, okay, from dollar to pound, okay, out of dollar and into pound in the deposit liability section, so that nothing changes, okay, in total. Okay, that's correspondent banking, okay, reducing those transaction costs using their mutual deposit accounts in respective currencies, right? So that's a very convenient way of doing it, doing FX transactions in wholesale market, by the way. Here's another example, correspondent banking practice problem. Bank X is in Milan and Bank Y is in London. So current exchange rate is 1.1 euro per pound. Now show the correct balances in each account if a currency trader employed at Bank X buys 100 million pounds from a currency trader at Bank Y for 110 million euros, right? So the balance sheets are shown in the next slide. So Bank X buys 100 million pounds from Bank Y in London. Now, here one interesting thing is that Bank X is in Milan and then Bank Y is in London. But Bank X, everything is shown in British pound terms, and Bank Y, everything is shown in euro terms and total asset and liabilities things, right? Does it matter? No. Hypothetically, it should not matter, okay? The key idea carries on, okay? Carries on. The idea about correspondent banking is that mutually they hold deposits in the other bank, right? And those deposit, okay, my deposit in your bank, okay, that account is my asset but your liabilities. And that I have two accounts, which is here euro account and pound account, right? And the same thing for you, okay? I have my liabilities deposit, which is your deposit, okay? And that's going to be your asset, okay? And that, you have two different accounts, pound and euro, okay? Good. Bank X, so what was happening over there in the story? Bank X buys $100 million from Bank Y for 110 million euros, right? So Bank X gives 110 million euros to Bank Y in exchange for 100 million pounds, right? Right, like this. And then what happens to Bank X's balance sheet, right? Balance sheet. You got 100 million pounds from Bank Y. So it increases your pound account, right? Asset increases by 100 million pound. I should change my color into this over here. And then what happens next, right? Then what happens next? Right, wait a minute. So the next is that $100 million increase, but for Bank Y, 100 million pound should be decreased, right? To reflect the reality, right? And then what happens next? Well, I got 100 million pound in exchange of 110 million euros, so I gave it to you. So that my euro account asset should decrease by 110 million euros. And that should increase the euro account asset of Bank Y, okay? So by 110 over here, okay? And then that means Bank Y's deposit in British pound should be going down, okay, which is what happened over here, right? And then, what else? Right, the liability side of Bank X, Bank Y's deposit should go up by 110 million euro, and then that should be balancing with the, what is this? This guy over here, right? They should be balancing each other out, and these two guys should match, and those two guys should match in the following ways, right? So increase and decrease in respective accounts for respective banks is happening in the correspondent banking relations like this, mutually holding those deposits. And international commercial banks communicate with one another using any of these followings. SWIFT is the most famous one, I think, or more longest history, maybe. Okay, SWFT. It's not Taylor Swift, but SWFT. What is that? What does that stand for? The Society for Worldwide Interbank Financial Telecommunications. So when you send money to somebody outside Korea, okay, what the bank asks from the, what's that? The bank always asks you, okay, what's the SWIFT code of the receiving guy's bank account? Okay, SWIFT code. That's the bank's unique number, okay, the receiving bank's unique number. So if I send money, let's say $1,000 to a bank in the United States, Bank of America, okay, I'm sending the money from Shinhan Bank or Uri Bank in Korea, then what I need to provide to my banker at Uri Bank is the SWIFT code of that Bank of America. Okay, why? Because those big banks, they have interbank relation, so the SWIFT code will enable them to find each other very well. CHIPS code is there, clearinghouse interbank payment system. ECHO is also there, Exchange Clearinghouse Limited, the first globally clearinghouse for settling interbank FX transactions. Now, next is about the spot market. Okay, spot market of exchange rate, right? So there are, largely two kinds, I would say, spot market versus forward market. Or, of course, in the forward market, plus some FX derivatives, right? Derivatives market. Spot market is like exchanging right now, on the spot, okay? Direct quotation is the US dollar equivalent. It works this way. A Japanese yen is worth about a penny, okay, in US dollar terms. That's called a direct quotation, okay, based on your home currency, right? Home currency. How much is it worth? Is a foreign currency worth in terms of your home currency? That's direct, right? US dollar, how much is it with respect, based on my home currency, Korean currency? 1,220 Korean won. That's direct quotation, okay? Indirect quotation is the other way around. Your home currency interpreted or translated into foreign currency. So Korean won, one Korean won, how much is it in terms of US dollars? Well, 0.00008 or something like that, okay? That's indirect quotation. And the price of US dollar in foreign currency. So, for example, you get 100 yen to get to the dollar, okay? How much your home currency is worth with respect to the foreign currency, okay? In the foreign currency unit, let's say. Direct quotation is your home currency unit. Indirect currency quotation, your foreign country's unit, okay? Exhibit 4 in the textbook looks like this. Exchange rates at some one point in 2016, right? You see, what you see in the first column is the country name, Americas, Asia Pacific, right? You see South Korea over there. Where are you, South Korea? Yes. And then Europe, and then Middle East, Africa, Bahrain, and South Africa, UAE, like that, right? And then, okay, that's country or currency. And what you see on the next column is in US dollar terms, and then their foreign currency terms, how much is US dollar, right? So in South Korea, let's go there, because it's, I'm South Korean. So from US perspective, from US citizens perspective, okay, saying $1 US is worth 1,179.66 Korean won. This is indirect quote. Okay, this is indirect quote. Right? On the other hand, this is a direct quote from Korean citizens' perspective. You see that? Okay, it's always like mutual inverse relation going on, right? And then direct quote of South Korean won, okay, is like from the U.S. perspective. 1 Korean won is 0.0008477 US dollars, right? That's the direct quote. And likewise it goes. Let's see. You see British pounds, right? British pounds. So direct quote of British pound is 1 pound is 1.4402 US dollars. Indirect quote is the reciprocal. 1 US dollar is 0.6944 British pound in the spot market. Okay, that's how we read it. Okay, you see Swiss franc going on. And then euro, that's 1.1321 US dollars worth. And the indirect quote works like 1 US dollar is 0.8833 euro. Okay, so that's how it works. Okay, move on. Right. Direct and indirect quotes. We take a part of the table in 5.4, and the direct spot quote for pound is 1 pound equals 1.4402 US dollars, and indirect spot quote is that $1 is equal to 0.6944 British pound. Right? That's easy. Note that the indirect quote is the reciprocal of the, did I say indirect? Note that the direct quote is the reciprocal of the indirect quote, okay? So conversion, okay, it's like there's a reciprocal inverse relation going on, okay? Then the bid price and ask price, okay? Bid-ask spread is also there in this kind of exchanges. Any market, right? Bid-ask price. Why do we have bid-ask difference, right? Bid-ask difference. Well, because of the middleman, okay? Because of the middleman, right? Somebody has to make the market, okay? Somebody has to connect those buyers and sellers, okay? And sometimes those middlemen have to keep certain amount as their inventory later on, to wait until the next buyer comes or next seller comes, kind of things, right? So they don't do this kind of middleman job for free. They want to charge something, 수고비 주세요, kind of things, right? Middleman price. That's what we call bid-ask spread, okay? The bid price is the price a dealer is willing to pay you for something. And ask price is the amount a dealer wants you to pay for something. So by definition, ask price have to be bigger than bid price, right? Bid-ask, okay? For the same certain asset, like it could be any used car or whatever car, or any product, or any currencies, right? Bid price low, ask price high. That's just by definition, it has to be that way. Why? The dealer keeps the difference. Okay, dealer in the broker or dealer, the middleman, okay, who makes the market going on. Okay, they keep the difference. Okay, of course they have to pay tax out of it, but that's basically the idea about bid-ask spread. Bid-ask, okay, bid-ask. It doesn't matter if we are talking about talking used cars or used currencies. The bid-ask spread is the difference between the bid and ask prices. And in Bloomberg Terminal or the the currency trader screen, they will always see this kind of for any pairs of currencies, they will always see this kind of bid and ask quotes. We call it quote, right? Quoting. Why is it quote? Well, they are citing your, the people in the market, okay, have to listen to how the, the dealers want this price to be, okay. Oh, if you want to buy US dollars, if you want to buy euro from me, right, if you want to buy euro from me, you have to pay me 1.3303. But if you want to sell your euro, then you should sell it for $1.33 per euro to me. Okay? Why don't you buy it more? Why don't you allow me to sell to you more expensively? No, I am the dealer. I am the Lord, right? I want to make money by being, the middleman. So that's why we have those difference. That difference is called the bid-ask spread.